There's a specific kind of panic in commodities that never really makes it to the main screens. It doesn't look like a crash, it doesn't flash red. It just looks like friction, a stubborn, irrational premium that just sits there, refusing to close, until eventually the physical market just stops functioning. I was going through the SHFE delivery schedules late last night, the Shanghai Exchange, and normally this is incredibly boring stuff. It's supposed to be. Metal comes out of the ground, goes to a refiner, sits in a vault, someone buys a paper contract, the metal moves. It's just plumbing. But right now, the plumbing in the East is making this sound. It's like a pump sucking air. You might have seen the number floating around the periphery of the financial web this week, 89%. It sounds like one of those hyperbolic thumbnails, right? 89% drained, zero supply. I honestly dismissed it at first. You learn to ignore the noise. But then you pull the actual inventory reports, the raw data out of Shanghai going back to the peak in 2021, and you trace the line, and the metal is actually gone. We are looking at stockpile levels we haven't seen since 2015, but what genuinely bothers me isn't the percentage itself, it's the behavior surrounding it. If this was just a standard cyclical deficit, a temporary mismatch, you'd see the paper price in New York or London adjusting to it. You'd see a normal, gradual shift. Instead, we have this entirely fractured reality. The West is still treating silver like a financial toy. They're trading it off CPI prints, Fed minutes, whatever the dollar index is doing this morning. Meanwhile, in China, they are practically sweeping the vault floors. They are paying so far above the global spot price that it is completely breaking the traditional East-West arbitrage models. I was looking at the logistics data, and there's this one specific flow I've been tracking. The physical movement of the metal via air.
You have to understand, you do not put silver on an airplane. The math doesn't work. It is way too heavy, and the nominal value is way too low. The shipping costs eat your entire margin. You put gold on a plane. You put microchips on a plane. You put silver on a slow boat. Except, right now, they're flying it. They are flying it because they can't wait 30 days for a ship. The industrial buyers, the solar manufacturers, the EV plants, they need the paste, they need the contacts, and they need it by Tuesday. The paper market in the West thinks there's plenty of time. The physical market in the East knows there isn't. Something has structurally snapped here. And in a few minutes, I'm going to show you why that 89% number, it's actually misleading. Because there is a secondary metric buried in the exchange delivery notices that tells a much darker story about what happens when this market tries to restock. You see, the problem with restocking in a drained exchange is that you actually need someone, somewhere, willing to sell you the physical metal. And right now, the people who actually hold the physical metal have absolutely no intention of giving it back. This is where the entire global market is splitting into two completely different realities. If you look at who is misreading this situation, it is almost exclusively the Western financial establishment, the paper traders in New York and London. You can pull up any standard analyst note from a major bank this morning, and they are still talking about silver purely as a monetary derivative. They are modeling the price based on what the Federal Reserve is going to do with interest rates next month. They look at the dollar index, they look at CPI prints, they look at ETF outflows, and they trade the paper contracts accordingly. To them, silver is just a hyperactive younger sibling to gold. It's a financial toy. They assume that if the paper price dips, it means the market is cooling off. They are entirely blind to the industrial furnace that has been turned on in the East.
On the other side of this trade, you have the people who are actually protected. The Chinese state-backed industrial giants, the conglomerates manufacturing the next generation of energy infrastructure. They don't care about the COMEX closing price. They don't care about the Fed dot plot. They care about securing the physical silver paste required to keep their assembly lines moving, because without it, the factory shuts down. They are perfectly insulated from price volatility because they have the credit lines to absorb it, and because they view silver not as an investment, but as a critical, non-negotiable raw material. And then you have the group that is massively, quietly exposed, Western manufacturing. Think about the European automakers transitioning to electric vehicles, or the American green energy contractors. For the last 20 years, they have operated on a strict, just-in-time inventory model. They don't stockpile raw materials, because stockpiling ties up capital. They rely on the London Bullion Master Association. They buy unallocated metal on a 30-day floating contract, operating under the baseline assumption that whenever they need a physical delivery, they can just click a button, make a phone call, and a truck will show up with the bars. They are assuming global supply is elastic. They are assuming the vault will always have metal. They are operating in a market paradigm that simply no longer exists. We are currently sitting in our 5th consecutive year of a structural supply deficit globally. 5 years. That is a hard, unavoidable mathematical reality. We are pulling less out of the ground than we are consuming year after year, and the gap is widening. This is where most people get trapped. When financial commentators see a multi-year deficit, they immediately fall back to Econ 101. They love to repeat that old commodity cliché. The cure for high prices is high prices. The theory is simple. If the price of silver goes up, 2 things happen. First, retail demand drops because it's too expensive. Second, people start melting down their grandmother's silverware and bringing scrap to the refiners. The supply floods the market and the deficit magically balances itself.
But this isn't 1980. This isn't the Hunt brothers cornering the market for speculative glory. Today, silver is going into technology. It is being consumed. Right now, nearly 200 million ounces of silver, roughly a fifth of the entire global mining supply, is being swallowed whole by the solar panel industry alone every single year. And here is the contradiction that completely undermines the mainstream narrative. You cannot scrap a newly built solar farm. The financial media assumes that if silver gets too expensive, the solar companies will just engineer it out. They call it thrifting. They assume manufacturers will just swap silver for copper to save money. And yes, thrifting is real. Engineers are constantly trying to reduce the microscopic amounts of expensive metal in a component. But you cannot retool a massive, multi-billion-dollar global supply chain overnight. The newest, most efficient solar technologies, like the TOPCon cells dominating the market right now, actually require highly conductive silver paste to function at scale. You can't just substitute copper on a Tuesday without degrading the entire panel's performance, increasing resistance, and risking rapid oxidation. The science doesn't allow it. More importantly, once that silver is printed onto a solar cell, baked into a panel and bolted to a roof in Bavaria or a desert in Nevada, it is gone. It is locked out of the secondary supply chain for 25 to 30 years. It doesn't matter if the spot price of silver doubles tomorrow morning. Nobody's climbing onto a roof with the crowbar to dismantle a functioning power grid just to melt down the contacts. The demand is structurally inelastic. The cure for high prices doesn't work here because the buyers have no choice but to pay. In a minute, you'll see why that number doesn't mean what people think, that 200 million ounce figure, because the paper market is entirely ignoring how the deficit is compounding and how it is forcing buyers to cannibalize the exchanges. If you want to understand how broken this has become, you have to look at the arbitrage.
This next part is where it stops making sense. If you understand how global commodities are supposed to work, you know that prices across different continents are kept in check by arbitrageurs. If silver is $29 in London and $30 in Shanghai, a trader will buy the London metal, put it on a boat, ship it to Shanghai, sell it for $30 and pocket the dollar, minus shipping. That simple, boring, repetitive action is what keeps global prices roughly identical. The gap between West and East is never supposed to be larger than the cost of slow boat shipping and insurance. Usually it's just a few pennies. Recently, the Shanghai silver premium has been running at over $5 an ounce above the international benchmark. $5, not 5 cents. On an asset that trades in the double digits, a $5 premium is not a glitch. It is a massive, gaping wound in the side of the global pricing structure. When you have a premium that wide, it completely breaks the traditional logistics models. It is exactly why the metal is being loaded onto cargo planes. The Chinese buyers are effectively standing on the other side of the world holding up a giant financial vacuum cleaner. They are paying such an absurd premium that it easily covers the exorbitant cost of air freight, the expedited insurance, the customs fees, and still leaves room for arbitrage profit. They are sucking the physical inventory out of the LBMA vaults and the COMEX warehouses at a terrifying speed. And the New York traders just sit there watching the paper price tick down on a Tuesday because of some obscure political nomination in Washington, thinking the market is cooling off. They don't realize that every time the paper price drops in the West, that arbitrage window to Shanghai just widens. The cheaper paper silver gets in London, the more aggressively the physical bars are air freighted to China. They're playing a game of musical chairs, but they don't realize someone is systematically removing the chairs from the room while the music is still playing.
The entire Western exchange system relies on a very delicate psychological trick. It relies on the assumption that only a tiny fraction of contract holders will ever actually demand physical delivery. Because the institutions playing in London and New York are mostly cash settling, just passing digital tokens back and forth to hedge currency risk or balance a portfolio, they assume the vault will always have enough baseline inventory to satisfy the one or two odd commercial players who actually want a real, tangible silver bar. But the East isn't cash settling. They are taking delivery. Every single contract they touch, they are taking the metal home. This creates an incredibly dangerous asymmetry. You have an exposed Western manufacturing base buying paper promises from an exchange that is bleeding its physical reserves to an East that is protected by deep pockets and industrial desperation. The metal is moving one way. It is a one-way street. And when you start looking closely at how the exchanges actually handle these physical outflows, you start to see the behavioral shifts, the quiet rule changes, the mechanisms they use to delay, to substitute, to quietly roll contracts forward. It all points to a system that is suffocating under its own rules. Because the real threat isn't just that the vaults are emptying. The real threat is what happens when the next massive delivery month rolls around and the authorized participants reach into the vault and they realize the math has finally caught up with them. The mechanism that actually governs this whole system is incredibly boring, and honestly, that's exactly by design. If you make the plumbing complicated enough, people stop looking at the pipes. But to understand how a market breaks, you have to understand how the exchange actually functions on a Tuesday afternoon when someone demands their metal.
Most people think of a commodity exchange like a giant static vault. You buy a futures contract, you own a piece of silver in that vault. But that's not what an exchange is. An exchange is just a matching engine for risk. It's a casino where miners hedge their future production against price drops and hedge funds speculate on price increases. The physical metal sitting in the warehouse, what they call the registered inventory, is just the absolute bare minimum required to keep everyone believing the game is real. It's a fraction of the paper contracts trading hands every day. The whole system operates on the assumption that maybe 1 or 2% of the contracts will ever actually stand for physical delivery. But when that 89% drain happened in Shanghai, the fundamental mechanism of the market started working in reverse. When an industrial buyer in China needs silver today, they don't just roll their paper contract to the next month like a Wall Street trader does. They hold the contract to expiry and they issue a delivery notice. They take the digital warehouse warrant, they cancel it, and they send a logistics company to the loading dock. This is the core mechanism you need to understand. Taking metal off an exchange is not a digital transaction. It is a slow, physical, brutal bottleneck. There are only so many loading docks. There are only so many armored trucks. There are daily loadout limits. And what we are seeing right now, under the surface, is a quiet manipulation of this exact bottleneck. When the vault gets dangerously low, the exchange doesn't put out a press release saying that you're running out of metal. They just subtly change the friction of getting the metal out. They increase the storage fees. They widen the delivery windows. They start offering massive off-the-books cash premiums to contract holders to settle in fiat currency instead of demanding the physical bars. They will do absolutely everything in their power to keep the metal from leaving the building. Because the second the loading dock actually stops fulfilling orders, the illusion of the paper price evaporates. This brings me to the behavioral signal that almost everyone is completely ignoring right now.
If you spend all day looking at the London Bullion Market Association reports or the COMEX daily volumes, you are looking at the wrong numbers. What looks important is the daily trading volume, billions of ounces changing hands on screens, creating this illusion of a deep, highly liquid market. But what actually moves outcomes is happening entirely off exchange. Because the Shanghai vaults are essentially running on fumes, and because the Chinese state industrial apparatus knows the Western vaults are also steadily bleeding out, they have quietly altered their procurement strategy. They aren't just buying from the exchanges anymore. They are going straight to the source. Over the last 18 months, we have seen a massive, unpublicized surge in direct offtake agreements. Chinese state-backed entities are going straight to the mining companies in South America, in Africa, even in Australia, and they are buying the ore concentrates before it is ever fully refined. They are signing multi-year contracts to buy the raw dirt, completely bypassing the Western refining system and the global exchanges. This metal never registers on a London or New York spreadsheet. It is mined, it is loaded onto a bulk carrier, and it goes straight to a sovereign smelter in China, where it is refined and immediately swallowed by a domestic solar manufacturing plant. This is a shadow market, and it is slowly starving the Western exchanges of their baseline replenishment. The analysts in New York look at the COMEX inventory and they think, well, the price is flat, so the miners must be preparing to send us a new batch of silver soon. They don't realize the new batch has already been sold off-market to a conglomerate in Shenzhen. The supply chain has been short-circuited. This is where the divergence between paper and physical becomes dangerous. The Western paper markets are pricing silver based on the assumption of a globally integrated, freely flowing supply of metal. The reality on the ground is a balkanized, aggressive resource grab where the fastest-growing industrial power on Earth is actively locking up the physical supply before it even reaches the open market.
I've been tracking the physical lease rates, the actual cost to borrow a 1,000-ounce bar for 30 days, and the numbers are screaming. In a normal, healthy market where there is plenty of supply, the lease rate is essentially zero. Sometimes it's negative, meaning someone will actually pay you a tiny fraction to store their metal for them. But right now, to borrow physical silver in size, you are paying a massive premium. The market is in deep structural backwardation. The people holding the physical metal are charging a fortune to let it out of their sight because they know how hard it will be to replace it. You don't see that on the evening news. You just see a ticker that says silver is down 20 cents today. And look, I have to stop here for a second and be entirely honest with you and with myself. Because when you spend this much time looking at a structural deficit, it is very easy to fall in love with your own thesis. You start seeing confirmation everywhere. So I constantly ask myself, what would invalidate this entire thesis? What would prove me wrong? If I wake up tomorrow and the paper market is right, if this deficit is a mirage and the price collapses back to $18 and stays there, it won't be because the Federal Reserve raised interest rates. It won't be because of inflation data. It will be because of a genuine, sudden technological breakthrough. If a lab at MIT or somewhere in Shenzhen announces tomorrow that they have successfully commercialized a solid-state battery or a next-generation photovoltaic cell that completely engineers silver out of the manufacturing process and they can scale it globally within 12 months, that breaks the thesis. If they find a way to use cheap, abundant copper in the electrical contacts without losing efficiency or risking sudden oxidation, the industrial panic vanishes, the demand floor drops out, the 89% drain suddenly doesn't matter, and the existing above-ground stockpiles are suddenly more than enough to cover the remaining traditional demand.
That is the real risk. You are betting against the ingenuity of engineers who are highly motivated to remove an expensive bottleneck from their assembly lines. But until I see that breakthrough actually functioning at a commercial scale, producing gigawatts of power on a grid, I have to respect the physical data, and the data tells me the engineers haven't solved it yet. They're still buying the metal. So strip away the noise. Strip away the daily charts, the macroeconomic debates, the geopolitical headlines. When you drill down to the bedrock of this market, you are looking at a system that cannot mathematically sustain its current trajectory. The Western exchanges are attempting to satisfy a relentless, inelastic industrial demand using a finite and rapidly depleting stockpile, while the primary buyers are actively securing off-market supply to insulate themselves from the inevitable crunch.
We are watching a slow-motion collision between a paper pricing mechanism that assumes infinite liquidity and a physical reality that is currently operating on 11% of its historical reserves in the East. So we are walking right into a very clear binary setup. There are really only two paths this can take from here, and the window for this to resolve quietly is closing fast. The binary setup we're facing now isn't a matter of if the market breaks, but how. On one path, we see a managed revaluation. The Western exchanges, realizing the vaults are effectively hollowed out, allow the paper price to catch up to the physical reality in Shanghai. This is the soft landing for silver. It's painful for manufacturers, but it restores the flow. The arbitrage window closes because the price in London and New York spikes high enough to stop the metal from being air freighted east. The higher price eventually forces the solar and EV industries to slow down or find those mythical technological substitutes I mentioned earlier. It's a messy, inflationary reset, but the system stays intact. The second path is the one nobody wants to talk about: the systemic failure of the pricing mechanism.
This happens if the paper market continues to suppress the price while the physical inventory hits that terminal zero. If the Shanghai Exchange or the COMEX has to declare force majeure, essentially telling contract holders, "We have your cash, but we don't have your bars," the game is over. You move into a bifurcated market. You'll have a quoted price on the screen that is meaningless because you can't buy metal at that price, and a physical price that is negotiated in the shadows, likely at a 50% or 100% premium. That is the moment of total disorientation for the global industrial supply chain. As I watch this play out through the rest of February and into the spring of 2026, I'm focused on a very specific scenario tree. If we see the Shanghai premium hold above $5 for another 30 days, the consequence is an accelerated drain of the LBMA. It means the vacuum cleaner is still on full blast. If, however, we see a sudden massive delivery of metal into the SHFE vaults, not from a mine, but from a sovereign treasury, it would signal that the Chinese state is stepping in to dampen the volatility to protect its own manufacturers. That would be a temporary reprieve, but it wouldn't fix the underlying deficit. Here is exactly what I am watching. First, I'm monitoring the eligible versus registered ratios on the COMEX. I'm looking for a specific behavior. When owners of eligible silver, people who just store it there, suddenly start pulling their metal out of the vault entirely. That's a sign of a lack of confidence in the exchange's solvency. Second, I am explicitly not chasing the short squeeze hype on social media. This isn't about a meme stock, it's about industrial physics. Trying to time a parabolic move is a fool's errand. What would change my stance? A sustained rise in LME and COMEX inventory levels that isn't accompanied by a massive spike in lease rates. If the vaults start filling up and it's easy to borrow silver again, then the deficit has been bridged, perhaps by a slowdown in Chinese industrial output that we aren't seeing in the data.
But for now, I'm staying measured. I'm staying quiet. The noise is for the people who haven't looked at the vault reports. When 89% of the inventory is gone, you don't need a complex chart to tell you that the margin for error has disappeared. We are operating in the final 11% of a decade-long cycle. The real question for you, and I'm genuinely curious how you're reading this, is whether you believe the paper price can actually hold back the physical demand of a global energy transition, or if the Shanghai drain is the first real crack in the West's control over commodity pricing. Is this just another cycle, or are we witnessing the end of the London-centered silver market? I'd be interested to hear the counter-argument, specifically if you're seeing any data on silver thrifting in the new N-type solar cells that I might have overlooked. Next time I want to dig into a specific document, the latest internal procurement guidelines leaked from a Tier 1 solar manufacturer. It shows exactly how much they are willing to pay above spot to keep their lines running. It changes the math on what expensive silver actually looks like.